Welcome back to Markets Today. It's the beginning of another week. We are getting to the tail end of November, so discussing what was happening on the NSE, as well as beginning to get our minds around how do we plan for the up and coming new year. If you have just joined us, a very warm welcome to you. Earlier on, we were discussing what was happening on the NSE last week. We did see a huge jump in terms of trading on Safaricom, which saw 90 million shares traded on Friday alone at a price of 32. Over and above that, we have been seeing a slew of incoming results from the banks. Last week, Absa announced, Cooperative Bank announced, Standard Chartered Bank also announced. Prior to that, KCB and Equity had announced. So today, virtually in studio, we want to find out what were these numbers like, what was the investor sentiment like, and what should we think about going forward. To unpack this for us, we are joined virtually by Ms. Linda Kiraithe, who is an analyst with AIB AXYS. Welcome to the show, Linda, and you can start us off by just giving us an overview of what was happening last week on the equities markets. Over to you, Linda.
Thank you so much, Mbithe. It's good to be back here to review the bank's earnings. And last week we saw a variety of Tier 1 banks release their earnings. And I would say the results are not really surprising as we expected. And we are seeing investors take these, I would say, a bit negatively because we have seen the banks drop in terms of their prices week on week. That is the price is lower compared to what was there before the release of the earnings. But I would say the earnings are just as expected. The market expected to see an increase in provisions eating into the bottom line. And this is because of the rise in NPLs. COVID-19 has affected businesses despite the fact that our economy is recovering slowly by slowly. We expect to see business continue to be affected. There have been shutdowns in some sectors of the economy, such as in tourism. In the education sector, it's starting to recover slowly by slowly. So the results are just as we expected. And I would say that investors need not to worry. Okay. Despite the drop in earnings, the banks still made some quite good amount of money. Their profitability is still in terms of billions, so we'd say that they're still making good money.
Okay, thank you so much for that. On a week-on-week basis, you are saying that the prices dropped. Of the banks that you look at, who was the worst in terms of losing ground in terms of price over the last 1 or 2 weeks? Over to you, Linda.
We have seen a drop of about 3 to 4% in KCB and Equity. And I would say this is as expected because both banks saw a drop in their earnings. But I feel this is something that is just bound to happen in the short term. I expect the price to gain momentum towards the end of the year and especially next year. Investors still hope for a dividend payment. However, there's no guarantee in that. And given that CBK actually had announced that they are the ones to approve dividend payments, given the rise in provisions, which of course affects the capital position of these banks, I would say probably we might see either a slash in dividend or no dividend payment at all. Okay. But I would say this is not to show that the banks have an effect on their fundamentals. It's just, I would say, the business environment that is not favorable. Okay. And I would prefer if the banks conserve this capital to use in operations and into onward lending once businesses open up.
Oh, fantastic. So I think that's just a point of caution for investors. Even as you are buying this particular banking stocks, just be cognizant of the fact that you might not necessarily earn a dividend for the year 2020. So in effect, you're really just buying it for capital appreciation. In other words, buying it at a low with the hope of selling it higher further down the line. Linda, let's start off with the 3 banks that announced last week. I'll start with the worst in class. Absa Bank third quarter earnings were down 65.4 percentage points to 1.9 million. Please give us your take on these numbers. Were this good? Were this bad? What did you like? What did you not like? Over to you, Linda.
I think for me, what was not a surprise was the rise in provisions. Barclays Bank has been quite exposed in terms of retail loans and unsecured loans. So you would expect that it would provide more for these loans in an environment where they're not sure of the payments, where probably they've given a repayment holiday to these customers. I would say what was quite discouraging for me was the top line. We saw flat growth in net interest income, which shows that the bank has been struggling to earn interest income. which, given that we would expect the eating up of the profit by provisions, you expect the bank to ensure to work more and see growth in earnings. But I laud the fact that the operating expenses were flat. This is a good thing, showing that the bank is implementing efficiency to see their cost down. There was also, of course, the expected transition cost of 1.2 billion. And this is also expected to be seen in the short to medium term as the banks transits from Barclays to Absa. Okay. So I would say the earnings were mostly in line with expectations, apart from the flat earnings growth.
Okay. All right. Yeah. So does it make sense to buy it at the current levels? We have seen a bit of slight upward take on price, and it was shy of 10 shillings or thereabout. Does it make opportunity for somebody to buy? Do you think there could be a bit of weakness based on these numbers, or what's your take on price, or if you even have a target price for this particular bank?
Okay, Barclays has always been a very prudent bank in terms of reporting, and I think despite the huge drop, this is what gives investors the confidence to buy banks at the current level, to buy the bank at the current level. So I would say, despite the 65% drop in earnings, if I were to buy, I would buy Absa, given that the bank has been very prudent in reporting, and the fact that they have a good dividend, given that this year, despite COVID, they are one of the banks that continue to pay their dividend despite the presence of a pandemic. Okay. So I would say the bank has continued to have confidence by investors, and that's why we are seeing, despite the drop in earnings, investors still keep on buying the bank.
Fantastic. Thank you so much for that. Let's move along on Standard Chartered, also announced in that particular week, and the earnings were down 30.4 percentage points to 4.3 billion. Are they good? Are they bad? What did you like? What did you not like, Linda?
This was also not positive because of the drop, but I think for me what stood out was the decline in unfunded income, which is not a positive thing in such an era where you expect, of course, the surge in loan loss provisions eating into the profit. You'd expect that the bank would do more to have more income in terms of non-funded income. And this was because of lower fees and commissions. Definitely, the bank would be affected by the guideline by the government to have transactions below, that is the mobile banking transactions free of charge. So it's expected that the bank would be affected. But I think Stanchart has been the most affected by this. We also saw a decline in interest income, and I would say this is because of the lowering of the CBR. So Stanchart seems to be quite affected by this also. So for me, the earnings were below expectations.
Okay. And it's interesting because when you actually look at the banks and you compare, say, Absa and Standard Chartered, Absa actually grew in terms of its non-funded income. But on the flip side, this particular bank, Standard Chartered, did not grow. Let me ask it differently. We know in terms of product offering, we have been seeing Standard Chartered being out there in terms of aggressively issuing investment opportunities to its clients. So now if you are part of the Standard Chartered portal, there is an element of them giving you an opportunity to invest, whether it's locally, especially globally, whether it's in US stocks, whether it's in Asian stocks, whether it's in global equities or global bonds or global commodities. Do you think there's an element of them possibly preferring to push clients to that particular segment as opposed to chasing non-funded income locally? Could there be an element of that, or really what was the rationale for a lower platform in terms of the non-funded income, whereas Absa was growing that particular line?
I think that can be possible, given that international stocks have performed well, especially tech stocks and stock in the pharmaceutical industry. So I would say probably that is what Stanchart chose for their clients. But then, given that customers still transact on mobile in terms of money transfer, mobile, the bank to M-Pesa and to other platforms, the pay bills, the payment of utilities. So I don't know exactly what happened there, but I would say it's quite discouraging, especially given that you expect Stanchart to be one of the banks that really has a lot of income coming in terms of non-funded income. Also, given that their clientele and their target market is people of the middle income age who who will probably, I would say, they would take up more of these products
Okay.
as opposed to the lower end of the customer base here.
Okay, fantastic. Thank you for that. So it's trading at about 145. It did touch a low of 139. Is it fairly valued? Do you have a target price for this stock?
Our target price is around 167 shillings.
Okay.
So the buy is, the upside is around 10%
Okay, so
currently.
not too much upside there. Okay, fantastic.
Yeah, not too much upside.
Okay, now let's look at Cooperative. That was the last one. We'll also take a look briefly at KCB and Equity. But Cooperative also announced last week that was a 10% drop in earnings to 9.8 billion. Now, Linda, everybody has been saying Cooperative Bank is not being as prudent as they should be, whereas everybody else has a double-digit, if not triple-digit growth when it comes to the provisioning line. This particular bank hasn't had that kind of impact. So what is your sense of this? Are they being prudent? Is there something that they're doing better than the other banks? And what was your read from this financial results? Over to you, Linda.
I also hold the same sentiments. I feel Bank have not really been prudent in terms of providing for their NPLs and reporting of their NPLs. Before the pandemic, we saw them as one of the banks that actually had a struggling book. So it is surprising that with the pandemic, their book is one of the least affected by this.
Okay.
And for me, I would say, given the exposure in real estate, which has been not doing well, we have seen low rental yields, and the occupancy levels have also been very low. I would expect, I thought COP would provide more, and we have seen the market say that this is not really a true representation of the loans. And also remember, COP has a big chunk in personal loans that is lending into civil servants. So probably that's why they have not really been affected, given that most civil servants have not lost their jobs and they are still on payroll.
Okay.
And also they're lending to SACCOs. I would say that has also been stable. But they're also exposed in this SME. So I thought they would provide more in the SME sector and in the real estate sector, seeing their provisions come up in comparison to their competitors.
Okay.
So, yeah.
Sorry, please go on.
Okay, so in terms of their earnings, I would say for me, I did not like the growth in the asset book. There was a single-digit growth in their loans. This is very discouraging. Compare that we see other banks, KCB, Equity, having really strong loan book growth, and we also for COP there's a decline in non-funded income. Before the pandemic, they were one of the banks that stood out as one of the banks that are able to have really a large portion of their earnings come from non-funded income. So this was also very discouraging, and also we saw the expenses come up. So given all these factors, I would say their earnings were not.
Okay. All right, Linda, can you still hear me? You're just taking us through. That was Linda taking us through the earnings from the banks. Last week, Cooperative, ABSA, and Standard Chartered all announced their third quarter financials. We're just sort of drilling down to see what was good, what was not good, and the sustainability of this particular numbers vis-a-vis the stock prices that we are seeing. So we're just waiting for Linda to come back on. But as we wait for her to come back on, in brief, Cooperative Bank numbers were down 10.3 percentage points. ABSA was down 65 percentage points, whereas Standard Chartered was down 30 percentage points. So we have Linda back on the line. Linda, can you hear me?
Yes, I can.
Okay, welcome back to the show. So, Linda, you were just taking us through Cooperative Bank, and you said you expected them to provide more because of the businesses that they have with the SMEs. So, I think the final question for you on Cooperative Bank is this. Because the other banks, especially the banks that announced last week, we saw Standard Chartered, ABSA down 65 percentage points. We saw Standard Chartered, I think, about down 30 percentage points. Do we get to the point where at the end of the year, Cooperative Bank now reports a material decline, maybe 20-30% decline, whereas during the year it's been a 10% decline? Is the risk of that feasible from where you stand, Linda?
I would not say that is the expectation, but I expect that to be done once the audited.
Okay, we need to take a short break. We will be back shortly.